What's going on, guys? Today I want to make this quick video discussing, what happens when a put credit spread or a call credit spread or some type of vertical spread goes against you. Pretty much how you manage that position, right? You got to have rules. As you can see here, I'm down $19 in this position I have with IWM. I'm not too concerned about it because I have a little bit more than a week left. But the stock market, I'm currently making this video January 28th, and it has been absolutely crazy this week. Look, if you're going to be watching this video in a couple months, this is the week that AMC, GameStop, Nikola, all these stocks are just going crazy. It makes no sense to me. I mean, all these big institutionals are, shorting it and, buying puts and stuff. And then now you have retail investors pumping it, throwing all their money into it. So it is just a huge, huge time right now for the stock market, guys. Robinhood's blocking particular stocks. Like, you can't buy AMC, GME, and different stocks like that. Like, this is unbelievable to me that a brokerage is not allowing their users to buy certain stocks. Turns out, I don't know all the details with that, but I do know there's a huge correlation with Robinhood and different hedge funds. Oh my gosh, I don't even know. I don't want to go down that path. But the video I wanted to make today was discussing how to manage your credit spreads, right? So if this was expiring this week, I would obviously be down a lot more than I currently am. And whenever you sell credit spreads, you got to have rules, right? So if you're smart, you'll definitely have rules and be responsible as far as when it makes sense to cut your losses. Sometimes you're just wrong, right? Sometimes you think SPY or whatever stock or ETF you do, sometimes you're just going to be wrong on the direction. There's different situations in our society today that are just going to reflect and affect the stock market. So you just have to understand that. And, that's how you ultimately build wealth over time. It's staying in the game. If you just want to make a quick buck, that's great. But you could potentially blow up your account too. You see all these people on Reddit and different Wall Street bets and stuff. They're going all in on calls and 1-day expiration calls. And that's great if it works out. But if it doesn't, what type of rules do you have? Are you just going to blow up your entire account and then have to start all the way from zero? I'm at the point now where it doesn't make sense to me to blow up. I have a capital. I'm building my capital week after week, month after month, contributing. It doesn't make sense for me to blow it up because I'm ignorant and I don't know how to manage my positions and cut losses. So definitely whenever you're selling options and investing, have rules, have a plan whenever you invest. Just blindlessly buying calls on different stocks, and like I said, it can work out great and you could become the next millionaire. And if that's you, congratulations, you have beat the system. But for the most people, it just doesn't work out that way. And I'm not saying you can't have YOLO plays and you can't have buy a call here, or, whatever it may be, which is, I do that sometimes, but I understand my risk and I understand my reward. And, sometimes it's good to take gambles like that and bet on, I don't know. There's just there's so many opportunities in the stock market. I just hate for you to put it all on one play and then blow up your account, right? So, sorry. The point of the video today is just talking about how to close your position. So you sold put credit spread, right? And the market's not looking real good. The direction you sold the spread for, it's definitely working against you. So you're kind of like in that position. You're like, well, should I roll it? Should I just buy it back and take the loss that I currently have? And ultimately, that just comes down to your personal preference. So definitely do your own research with that. There's all kinds of different rules and different recommendations people do on the internet. But, that's just going to be something you're going to have to personally be okay with, based upon your risk tolerance and your time horizon and all that different stuff. Where a financial advisor can definitely, help you figure that stuff out. But I personally am not, so I'm not going to recommend what particular rules you should follow. But I will express, some things that come to my mind as far as this may go. So as you can see here, I originally got a $25 credit for this put credit spread here, and I'm currently down $19. So I am almost down 100% of my credit, which it's not too bad. I do still have a week till expiration, a little bit more than a week. It's Thursday, and it expires not tomorrow, but the next Friday. So I do still have, time decay and time for this option to play out. But it's getting kind of closer to that runway than I typically would like. As you can see here, the current price for IWM is 208, and my short position is that 202. So a $6 runway, that's getting kind of close. So this is one that I would definitely want to pay attention to and make sure. I could cut losses now and only be down $19, right? And just go upon my day, and I can always make that back next week. But if I don't really manage this well, and the market continues to go against me, and eventually my spread is in the money, or my short position is in the money, then my risk is much higher. I'm talking about losing $200 at the minimum. 200 minus the credit I received, so it would be $175 here at the minimum if everything exercised correctly, with my broker and stuff. But by all means, you still have the risk of only one of your legs exercising and then the other one just not. So then there's, kind of like how I talked about in another video where someone did like a Tesla spread before, and he thought his risk was only X and Y, but really, one of his legs exercised and the other one didn't till $40 later. So he lost like $20,000 or something on a spread where he thought his max risk was only $400 or $500. So yeah, so some things I like to do. I never like to let my spreads go in the money, and especially if they're in the money, I'm going to buy it back. I'm not going to let them exercise by themselves. And two, if I'm ever down 2x or 3x of my credit, so in this situation here, if I'm ever down $50 to $75, I'm going to look to potentially, just cut my losses and buy that contract back, just because it doesn't make sense for me personally to stay in that trade. But I mean, like I said before, it just comes down to, how risky you want to be with that. So yeah. But if I wanted to, just say it was February 5th on the day of expiration, right? And I didn't want to close this spread out completely. Like I know on some brokerages, like there's fees. Robinhood doesn't charge fees for options, but I know on some brokerages there's obviously fees, 65 cents a contract or whatever it may be. If I want to limit my risk, how can I do that? Right? So where's my risk in the biggest part of this? My short position. So I sold this 202. So that is my risk, right? So that is I'm giving someone else the right to exercise the 202 strike option. So if I want to limit that particular leg as much as possible, I can just buy back that particular leg. If I don't want to close out the entire contract, I can just buy back that leg. And to do that, you just go to the short put. So this is my short put. I would just come here, day of expiration, click buy, and buy it or whatever. So I'm buying back my short. So you can see this is -1. That means I sold it, right? And then I sold it. So now I'm buying to close. You see that? Buy to close. Release collateral is $200. As you can see here, it's a lot more to buy that back. $240. Compared to just closing out the spread altogether for $45. But if you believed, the stock was going to continue to go down, and you wanted to keep your long position, so this 200 put, so say you believe that the stock was going to continue to go down like another 20 points or whatever, you could continue to make money from that long position there. So you can see this $200 put here. I'm making, or not, I'm not making. I'm actually up. So if I wanted to realize my loss on my 202 put, that's great. If the stock continues to go down, this value is going to continue to go up. You look at the delta here. The delta, it's actually 24. So every dollar that this stock or ETF continues to decrease in value, this contract value is going to go up. So say it drops to 206, that's another $2. This contract is going to go up by a minimum of another $40 or $50 there. So by all means, if you want to keep that long position, go ahead. In hindsight, if I would have just bought this long put, I could have been sitting at a pretty good position, up 90% on my original investment. That's a pretty decent return right there. But the win rate of just buying calls and puts are significantly less, in my opinion, compared to selling options. But yeah, guys, that's pretty much it for this video. I just wanted to pretty much discuss managing your positions. Definitely there's more that goes into this. Like I said, speak with a financial advisor, speak with other experienced option traders, talk to them about when they feel it's a good time to cut their losses, or, let them to continue to run. Ultimately, that's going to be something that's just, comes with experience, and just depends on the environment that you're currently investing in. All environments are different. Like I mentioned earlier, this past week has been unbelievable. Like, you have brokerages blocking, retail investors from buying stocks. It's just unbelievable. The environment that we're currently living in are crazy. So I just want to make this video just to, maybe help someone stay a little safer with their spreads. The last thing I want to see is someone blow up and lose their entire collateral for this spread here. I personally don't think it's worth it. You can always just cut your losses and move on. It's all about preserving capital, continuing, in the investment game as long as you possibly can. It's a marathon, not a sprint. Don't try to hit the home runs all the time. Sometimes you can swing for the fences, but most of your at-bats, in my opinion, should be, solid and, well thought before entered. Always know your risk, always know your reward, and always close your spreads before expiration. That's my biggest advice to beginners and traders that sell spreads. All right, guys, thanks for watching. Please hit that like button and subscribe below if this video provided any value for you guys. Best of luck with the rest of 2021. It's going to be a crazy year, guys. Stay safe out there. Thanks for watching.